Hey, we're live. Thank you so much for joining me. I'm Mitch Goldberg. You're watching our live stream, Be the Boss of Your Money. Let me know where you are tuning in from. And if you have any questions about what we're talking about, definitely ask me in the comments. We're going to talk about the two different kinds of inflation. And I don't mean consumer price index and producer price index. I mean, the two kinds of inflation that we live with, the kind that we investors pay attention to, and the kind that we pay attention to as consumers. So, if the stock market's been going up on expectations of lower inflation, and inflation has been trending down, then why is it still having political ramifications in terms of Trump versus Biden? And people are still talking about inflation like it's so bad. Well, it is pretty bad. So let's talk about what we see, and we're going to talk about some changes in the market and finally a shift we're seeing because we're seeing some of these mega cap stocks start to go down. I heard a commentator, Ed Yardeni. I've been quoted with him many times in articles on CNBC, just a humble brag there. And he said there's two benchmarks. There's an S&P 500 and then there's the S&P 493. So all the stocks underneath the Magnificent Seven stocks of like Apple, Meta, Alphabet, Tesla, the usual names we talk about every day, NVIDIA. So let's get into the quick intro and then we'll have a good quick show. Stick around. This is going to be enlightening. All right, thank you for joining me. This means a lot to me to see you here. First, first thing I want to do is I want to talk about the two different kinds of inflation. Today, the consumer price index came out, an inflation figure that measures what? It measures the pace of inflation that you and I pay for common goods. And it was about 3%. It was down a little bit lower than expected, lowest number in 3 years. Stock market, for the most part, has been very happy about lowering inflation, like we all would be. But understand that investors might be happy about that. But why aren't consumers saying, "Oh, inflation is terrible. Things are so bad," and then politicians will come out and say, and economists and financial advisors, for that matter, will come out and say, "But inflation's been going down. It's down from its peak. It was at 10% at one time, and now it's like 3%. We're very close to the Fed's target of 2%. So you should be happy." So let me explain something. Consumer price index, that index measures the current pace of price increases. It doesn't mean prices are going backwards. It just means that maybe prices were going up at 5% on an annual basis, then 4%, then 3%. It basically says that the rate of upward price movement has slowed down a lot. And that's one measure of inflation. But still, prices are up a lot from some point. And the point that consumers are still comparing inflation to was the point before the pandemic started. So investors are still living, not investors, consumers, I should say, are still living with prices of 2019. That's the figure in which they judge things. Well, prices were 2019, and prices during 2019 are a lot lower than they are now. So even though inflation's coming down from what? Prices are still up. So maybe they're not going up as much. So that number, the rate of change has come down a lot. But until we see prices get back down to where they were, at least based on our memory of where they were in 2019, we're not going to be happy. And this is why consumers shrug off inflation. And this is why Biden could talk about inflation figures coming down. And this is why Trump could talk about sky high inflation, because you're talking to two different audiences. And the thing I'll say about Trump is that he really knows his audience. He knows who he's talking to, and he knows that people are looking at prices based on 2019 and where they are today. So that's a lot of inflation. Biden is using what he can, and he's saying, well, listen, the inflation rate's going down, so you should be happy. But just because prices are going up at 3% a year and they were going up 2 years ago at 10% a year, I'm still paying a lot more for everything than I was a couple of years ago, which means my standard of living is less. My standard of living has been lowered because of inflation. So don't tell me that inflation is down when I'm paying more money for everything. You have to know your audience. And this is why when I feel like financial advisors are talking to their clients about inflation, it's like neither person understands each other because we're talking about two different kinds of inflation. But once you realize which kinds of inflation you're talking about, the conversation at least will be a lot smoother. Not necessarily more pleasant, but a lot smoother. All right. So today was an unusual day because small cap stocks went up about 3%, while S&P 500 was off about 2%. So there's a big gap between the performance of small caps and large caps. And today is considered the biggest gap in that ever. And this has only happened maybe one or two other times in stock market history where the S&P and Nasdaq go down a lot and the small cap stocks actually defy that gravitational pull and go up. And this is all, in my opinion, I want to put this, there's lots of reasons for it. One reason is because large cap stocks in particular, the biggest seven stocks, the magnificent seven stocks, the S&P 500, have been up so much that valuations are stretched and investors feel like taking profits. We've been talking about this for months that, hey, maybe it's time to take some gains, but making the decision based on how much of a concentration you have in these kinds of large, mega cap stocks. Like, if you're investing in the S&P 500 index fund, for example, and by the way, you can't invest directly into an index, but you could invest into a security that mimics or tracks an index. You could buy product for that, but not the index itself. But we used to call the NASDAQ all the time the tech-heavy NASDAQ, like back in the year 2000, 1999, the tech-heavy NASDAQ. You couldn't say the NASDAQ without saying the words in front of it, the tech-heavy. So you'd always have the tech-heavy NASDAQ. I would say the S&P 500 is almost as tech-heavy now as the NASDAQ was back in 2000. And at some point, tech stocks start to go down. If you feel that the market has been rallying based on expectations that the Fed would begin cutting rates, then what happens when the Fed cuts rates? Often the market goes down, at least in the beginning, when the Fed starts cutting rates. Typically, the Fed cutting rates signifies a slowing economy and maybe a recession on the way or already in a recession. So now I don't think we're in a recession. I don't think a recession is imminent. Not to say that a stock market correction can't come around, but recessions and stock market drops are not always cause and effect. Sometimes they're just coincidental. Having said that, we've been talking about this. If you have substantial gains in certain stocks, you need to take a look at your own personal finance, your own money, your own portfolio, and ask yourself if you should reduce some of these positions. And if you have an index like the S&P 500 or an S&P 100 index that is really just up a lot because of a handful of stocks, which means it's now it's a much more concentrated portfolio, not as diversified as you may think. Maybe that's something that you should take a look at, reducing and reallocating that money into something else. Someone recently said to me, "Oh, I'm all in the S&P 500 and I'm diversified." The S&P. This is not your father's S&P 500. What we have today, it's not nearly as diversified as it used to be because of how swollen tech stocks are now in that particular index. But these are really matters of personal finance, and if you need help with these matters of personal finance, you can certainly reach out to me and I'll walk you through it. I'll teach you all about this stuff and we'll have a conversation and see what your next step could be, because I just want your next step to be the right step for you and not to give, blanket information or blanket advice on a broadcast. All right. So today the Dow was still up a little bit, but the S&P and Nasdaq were trading at new records this morning because every day, why not? They've been hitting records lately. They finally backed off, and they backed off pretty good. So let's take it to the tape, and I'll go here. All right, so the Dow was still up 32 points, but Nasdaq was down almost 2%, S&P down almost 1%. When you have stocks like the big ones, okay, Amazon, Apple, Microsoft, the biggest stocks in the Nasdaq, when they're all down, and they were all down today, and they make up such a large part of the S&P and the Nasdaq that those indexes can't help but go down. The other stocks just don't have the heft to lift it to compensate for that. But a lot of stocks did go up today, and that's why mid cap and small cap stocks did relatively much, much better. Just to pull up a quote on mid cap stocks, because, yeah, okay, so check this out. Oh, let me go back. Let me go back. All right. I messed that up. There we go. Mid cap stocks is measured by VO. That's the Vanguard Mid Cap Index Fund ETF. That was up over 1% today, and small cap stocks were up about 3% today. So there was a pretty nice shift, the rotation. Let's get back to interest rates. When interest rates start to go down, since small cap and mid cap stocks are more likely to borrow or more likely to have higher borrowing costs, they're often borrowing from banks where they're not as big, so they have to pay higher interest rates, are considered riskier than their large cap brethren. When interest rates go down, it helps these kinds of companies become more competitive. And with the outperformance, it's only a day, I get it, but with expected outperformance, which I think is what is expected now for small cap and mid cap stocks, you could actually see the IPO market start to open for smaller companies. So lots of companies will be able to raise cheap sources of cash. So, and do lots of IPOs and investment banking deals, things like that. So that's why you have this shift from the super large cap to the smaller companies. Do I think it lasts? I do. Can't guarantee it. And this is why we just own all of them. And it's not necessarily owning everything, and that's the end of it. We do a fair amount of diversification differently for different clients. Diversification, that is a strategy that doesn't necessarily protect your portfolio from going down in a generally down market, but it does help mitigate risk of your portfolio. It does help mitigate downside risk. And plus, when your portfolio is down less in a down market, your portfolio can recover quicker when the market recovers. So lots of reasons to be diversified. And that is the show today. I'm so glad you joined me, and I am looking forward to getting back to doing this show a little bit more regularly. May and June have been crazy months. I have this expectation or this hope that things will calm down. They never do, but I expect to be doing the show more regularly. So please keep tuning in. If you're watching this in the live stream, great. You could watch it in the replay. It's always on my timeline. So check back to it. They're all educational. And with that news, I will get back to you soon. Thank you very much. Have a great day.